Okay. Ooh, ooh, ooh. We already have a question. I love it. I love to see it. I will wait um, and get a few more people in, and then I'll start the review for this month. But this is a great question. I can't see who's in the chat. I'm doing this differently today, so I can't see anyone. Let's see. Can you all hear me? Put it in the chat if you can. I can see that people have joined, but I can see the number, but I can't see who it is. You can hear me? Okay. All righty. Thank you. Hi, guys. Happy May. It is May 1st. Can you believe it? This year is flying by. And as I do in every video, I'm going to go over the previous month's budget and bills. Thanks, Nichelle. Hey, girl. Hey. So I'm gonna go over the previous month's budget and bills. We had an interesting April. I feel like I say that about every month. I'm waiting for a month to be normal. I don't even know what normal is anymore because it seems like every month is just up and down now. But I'm gonna go over my budget for last month, my bills. I have my personal laptop here where I keep my budget. So I have the real numbers. And then after I go through all of that, we have a very, very special guest. And I know a lot of you really wanted to know about how to reduce your tax liability. That was one of our requested topics when I said I would be going live every month. So I am really, really excited to have my fiance. And I think that's the first time I'm saying that on YouTube, my fiance come in and give us tax tips from a tax professional. So I'm gonna go ahead and get started with April's budget and bills. Hello, thank you so much. Thank you so much. Oh my gosh. Okay, so you have a like all out Sweet 16 party for your baby? I don't know if it's a daughter or a son, but did you go like Did you rent a hall? Like what was this 16-year-old party like? He had 3 parties. Wait a minute. I love it. Okay, so you're probably like me, like nothing is normal in April. So I'll go over, my goals. I always start over with what are my goals for the year. So my first goal, you already know, I need to pay off debt. And now that I'm going to be somebody's whole wife, I really need to pay off all of my revolving debt. And I gave myself a goal to do this by mid-year. I wish now I had set like a more stringent goal, because trying to think of planning a wedding and having debt is not something that mixes. So where am I in paying off my debt? I paid off in the month of April an additional $1,320.20 of my debt. So I have balances remaining on 3 accounts. One is PayPal, one is Best Buy, and the last one is Nordstrom. Now, should I have a balance on my Nordstrom account? The answer is no. I'm not doing well. I really need to rein in my spring, summer wardrobe shopping. And that's my issue. I really shouldn't owe Nordstrom anything. Do I pay off the balance in full every month? Yes, I do. So that's great. I don't get charged any interest, but I need to get to a place where I'm just not using the card, and I'm not there yet. So I like that we can be transparent, and I'm always transparent. I don't have it all together, and that is one area that I need to get together like real quick. Secondly, I wanted to add 3 months of expenses to my emergency fund. And I don't think I ever told y'all what my ultimate goal was for my emergency fund. And that was to have about $30,000 saved up. And that's approximately 50% of my annual expenses. So that means I would have had like 6 months of expenses saved up. That's my ultimate goal. I added $5,000 to my emergency fund in the month of April. So I felt really good about that. My total, like how much do I have saved right now, is about $20,000 for my emergency fund. And so I have $10,000 to go. But although I've added about $12,500 this year, I used about $5,000 in January when I was transitioning to my new job and I hadn't gotten paid yet and all of that. So that's where I am. That's the total goal for my emergency fund. I want to have 6 months saved up. And I think if I ever get laid off again, I definitely want to be able to comfortably not work for 6 months. I feel like although I got laid off and I took 2 months off, I was really like interviewing and everything. It was the holidays. It was busy. I didn't feel like I really had a real break. If it ever happens again, I'm going to take the break. I'm just saying, I'm going to take more of a break. Third goal is to add no new debt. I already told y'all I'm struggling there with Nordstrom. I really need to be finished shopping. And so that's really one issue that I'm having, this whole add no new debt. I keep using my Nordstrom card to purchase things, although I'm like, oh, I can afford it and I can pay it off. It doesn't mean I don't care if I can afford it. I don't need anything else. And honestly, the best thing I did in April was take the Nordstrom app off my cell phone. It is not there anymore. I have to go looking if I want to find anything on Nordstrom. And that's the hurdle I put for myself in place. 4, start saving for a new car. I actually started Last month, I did not add anything to the fund in April, but ultimately, and again, I never said what that ultimate goal was. I want to have about $15,000 saved by the time Baby Benzo goes kaput. Baby Benzo is about 12 years old, and she's not gonna last forever. So I'm trying to get like 15K set aside so that when I need to go shopping for a new car, I have some money set aside, because cars are really expensive compared to the other two cars I bought. I'm gonna cry real tears when I have to pay for another car. So I want to have a good down payment ready when it's time, like when she dies, because I'm not gonna buy one until she dies. I just want to let y'all know that. Okay, 5, save for my home renovations. In the month of April, I saved $4,000 towards my home renovations. But I will tell you, some of this money that I've been saving towards these home renovations, they are going towards home maintenance starting in the month of May. So now that it's a little clearer outside, I'm going to get roofing patched. I'm going to get this powder room painted, the exterior, some doors painted, and then I'm going to start looking to redo the powder room, which is kind of like the last room that I ultimately like really, really hate in my house. So that's what I'm going to start in the month of May. So y'all pray for me, because I'm taking on something new while I have a lot of other things going on. So things I was supposed to do this year: start a bag fund. I started a bag fund. I opened it in March, and I put an additional $1,000 in my luxury bag or shopping fund in the month of April. And so I had, by the end of the month, I had about $3,500 in my bag fund. 2, I wanted to invest in the extra money I got. I will tell you that is no longer the plan, because my pool put a ring on it, a whole diamond ring. And so any extra money that I have is going to the wedding fund. Yes, and I actually started that in March, and I'm gonna do even more. I did more in April, and I'm gonna kick it up a notch every month. And then 3rd is to open a new car account, and we talked about what I did there in March. Go check out March's video where I go in depth about money market funds and high yield savings accounts, and you'll understand where I'm actually saving this money when I tell you I'm saving it. And then 4th was hire a designer. And the best I've done thus far is to find a house painter. And it's because I've had 2 contractors, and one still owes me money to this day. I don't want to work with either one of them again. And so I'm a little jaded about hiring new people for my house. And I'm just going to be honest, like the research and everything that you have to do for that, I'm just tired. I did that in 2021 and 2022, and I don't know if I have the energy for it right now. So I'm going to test it out with just some house painting in the month of May. Okay, now let's go over April's budget and bills. And this month I have it separated between some positives and some negatives. So positives, and this directly relates to our topic for this month, which is I filed my taxes in April. I think I had 2 days before the deadline. I got it in. Yes, that's it. Okay, yes. And I have the money. I'm with you, Kimmy Kim. Like, you pay these people, they don't show up. They take your money. You don't know if you're gonna like the work in the end or if it's gonna need to be redone. It's a whole thing. If you've never remodeled a house, y'all, it is not for the faint of heart. Like, you don't know if you're gonna be directing the people like, oh, do you see the paint chip right there? Or, oh, you installed this, can you come back? Sometimes it's just a big headache, and life is kind of peaceful at the moment. I'd like to keep it that way. Okay, so let me go to financial positives and negatives. I got a tax refund, y'all. Now, when I do my taxes, I'm never someone that thinks they're going to get a refund. I have been, for probably the last decade, I've been anywhere from owing $1. Yes, I had to send them $1 one year, and maybe getting like $300 back. To me, getting the $300 back was a win. I try to be as close to zero as possible, honestly, every year. That's my goal, that's my target. But this month, or last month in April, I got a tax refund. I got $4,948. Yes, because I am like Kimmy Kim. I put zero on there. I let them take the money out. And I did have a couple, like I worked, but then I got laid off, and then I had unemployment, and I all of this stuff going on last year. So what did I do with my tax refund? I'm glad you asked. So one, I saved $3,000 for my upcoming wedding because I only got the tax refund. I think I got it 2 to 3 days after I got engaged. So at that point, reality had set in. Like, girl, any extra money you get, you are not investing, you are saving for a wedding. This is now an immediate and urgent reality for your life. So I saved $3,000 for the wedding, and then I put $1,000 into my bag fund. The rest went on just some shoes I bought from Nordstrom, because everybody just want to treat yourself sometimes. I love that little meme that comes on our Instagram when they be like, treat yourself, fine leather goods, treat yourself. Like, that was me after I saved $4,000. And so I guess the $948 was the treat yourself portion. Okay, so then secondly, I took a job, and I told you guys at the beginning of the year, I took a job that had a lower base salary, but that we would get quarterly bonuses or like commission checks or whatever. And that was a risk for me because normally, I'm like, give me all my money up front. I want it known. However, my company did come through. I got my first quarterly bonus. And so what did I do with that money? I saved it. And I'll tell you all the categories that I saved it in later. Third, April was good financially. I had some good positives. Third, I got a mortgage escrow refund. So if you own a home, you might be paying into your escrow account every month, and your mortgage company is saving money to pay your taxes, your insurance, your PMI, all of these things over the year. And then at the end of the year and like a few months later, they'll recalculate what you need. And for 2023, they were like, wait, you paid us way more money in 2022 than we needed. So we're going to refund you some of that money at the top of the year. And so in April, I got a refund, not just from my taxes, but from my so you got me laughing, girl, but keep spinning. So I got a refund from my mortgage company as well. My refund there was about $2,400, and I saved $2,000 in my house fund. Because I honestly think these people are going, in 1 year, they're going to come back and say, oh, you didn't pay enough, and I need you to give me that $2,000 back. So I saved that money. And then with the like $435, that was the treat yourself. So after I save, I treat myself. That's how that went. Let me look at the comments. I'm glad you made it too. Oh, I see my cousin Jeremy. joined. Hey, Jay. Yes. Oh, yes. I'm still on my weight loss journey, y'all, even though I'm sitting at like, as of this morning, I was down 22 pounds and I still had like 2 pounds to go to my 24-pound target. I'm still on it, but I feel like I look and feel so much better. So, yes, in addition to these financial goals, I also had weight loss goals for this year, and I've been trying to hit both of those. Okay, let's see. So, for the month of April, with all of the financial wins, I was able to save $17,820.80. And I also was able to give $3,000 to charity, broken up between my church and two charities. So those were my financial wins. What went wrong in April? Like, I felt like I could have won a little bit more. Number one, again, my shopping. You know, the whole treat yourself attitude. You know, I treated myself. I went out to eat. I took my fiance, then my boyfriend out to eat, and it was good. And I can't say I couldn't afford it. I could, but could I have saved more money if I didn't treat myself? Yes. But do I want to live that life? No. That's boring. So look, if y'all coming here for the best tips, I keep it real. I keep it raw. Like, I'm gonna get my hair, my nails, all of this stuff done. We just gonna fit in the budget. We gonna eat good, but we gonna save money too. And that's kind of what I'm trying to teach. Like, live your best life, but take care of your future as well. So shopping, that was a problem. Number two, the cost of hair, nails, and I bought makeup. I trashed a lot of old makeup and needed to replace it. Y'all, the cost of everything is just so high. You know, this is not Savannah, this is Summer. I went back to Summer. I got her cut. I got her curled. I love her. Yes, YOLO, you only live once, but okay, girl, that's enough. Like, we are living, we are really out here outside living. Like, we're doing some good things, but I don't want to get so comfortable treating myself that, you know. Hey, hey, yes. We all need to treat ourselves. You know, you get your hair done, you know, get your little mani pedis. But the cost of everything has gone so high that when you treat yourself, you be looking like, is that the real price of this? Oh, I talked about that last month. The cost of self-care. Yes, it went up, but as you can see, I didn't stop. I still did it in April. And then the last kind of budget and bills issue that came this month were costs for my dog, or last month, April. Dog costs. Do I have a line item in my budget for my dog? And if any of you, I know Nichelle is thinking about getting a dog. You need to have a line item for the dog. The dogs will kill your budget if you're not careful. So I save every month, or I have in my budget $300 for my dog. That includes his grooming, his food, buying him clothes, taking him to the vet, anything like that, $300. Why did Prince Mighty cost $665? He got shots, he got heartworm medication, you know, all of this. And today is May 1st, and he already went to daycare and got groomed today. So he's already starting off, you know, I guess he said he gonna treat himself too, but it's part of my budget. So those were the things that caught me. Yes, Rainy. It is just like having a kid. And so when people ask me about having a dog, I'm just like, they're like toddlers that never grow up and never learn how to talk. Like, that's what having a dog is like. But I'm about 10 and a half years in this thing with Prince Mighty now. So he's mine. I'm going to stick beside him, you know. But any questions for me before I bring in our tax professional? Any questions about the budget, the bills, anything about April or things that have happened? Yes, they are. He is my child for sure. Okay. So now I'm so excited to have Todrick coming, and he's going to give us some tax tips. And I'll say us because I need these as well. Hi, say hi to the peoples.
Hello.
You want to introduce yourself? A little background?
All right. My name is Todrick. Um, I work for a tax resolution firm here in the city of Houston. We are one of the leading tax resolution firms in Texas. Um, been doing this for the last 7 years, working in this type of business. I'm not a CPA. I'm not a tax preparer, but I do work with those individuals. My specific task that I do for our company is that I deal with persons who basically owe the IRS money. I deal with persons who are out of compliance, and we work with them to use the tax law, the tax code, to their favor to help them, number one, get back in compliance, and then number two, help them resolve their outstanding debt that they have, and then help them correct what they're doing so they don't get back into the same situation. Because once you do go to the IRS and you're able to get resolution for it, one of the agreements that you make is that moving forward for the next 5 years, you're going to file on time and you're going to pay whatever it is that you owe. You can't come back every year saying, I need help, I'm in trouble, that kind of thing. So, but that's what I do. I'm a financial analyst. And so I spend my days analyzing people's tax problems and giving them the tools that they need and helping them rectify and correct their problems. So,
Yes, let me just tell y'all, I didn't bring y'all just nobody. Okay. I brought y'all a real professional, but look, consult your own tax and financial advisor.
Definitely.
For all issues that you may have. Do not take us, we're just giving general tips, but for your specific situation, you need to have a specific advisor work on your account or your issues. Now, with that being said, he does know what he's talking about. Okay, so we're going to get into it. Tax codes change every year. Yes. Every year is always something different. So what's new in the tax streets that we need to know about?
So the good thing is that there are some major changes that are taking place for 2023 that is going to bring a lot of relief for persons for various reasons. There are a lot of changes. Like I said, they change every year, but there are a lot of changes. But I'm just going to touch on some of what I feel are the most beneficial that are taking place that will help you. I know someone already started asking a question about, I work 2 jobs. So some of this stuff is going to help you next year with that. The biggest thing for 2023 is about the income tax brackets. Now, we're taxed. We have seven different tax brackets that we can fall into based on the level of income that we make. And we're really not based particularly on one percentage. We're taxed on a marginal tax rate. That as we make money and as we grow higher, we begin to get taxed a little bit more as we make that money. So certain portions of our money are taxed at certain rates. And then the higher we go, the more they start taxing us, not over all of our money, but on the money that falls in that particular tax bracket. So what they've done in 2023 is they didn't increase the tax rate, but they widen the tax bracket. So what that means for the taxpayer is you can make more money and get it taxed at a lower level.
Oh,
okay. It's not a whole lot. Don't get excited. Not a whole
lot. I'm sorry.
But it went up a little bit. It went up and it goes, it's an increment. So for 2022, the first $10,000 was taxed at 10%. Now they've taken that up to the first $11,000 is going to be taxed at 10%. Then you go from 11,000 to 44,000. And I'm just giving rough figures, not the actual numbers for brevity of time. From 11,000 to about 44,000, that money is taxed at 12% this year. When last year it was from 10 to 41. So you see that's a bigger hike. The first hike was just $900, but the next hike was like $2,000. So it keeps going higher and higher. So that means for the taxpayer, you're going to be able to make more money and get it taxed at a lower rate. And so that's a good thing for persons who are making money, who are getting raises and things of that nature. Your money is going to be taxed at a lower rate. Okay, more of your money is going to be taxed at a lower rate. The second thing is the standard deduction has increased. The government knows that we're dealing with inflation, and so all of this is a part of the Inflation Act. All of these things and changes that I'm bringing up, many of them are a result of the Inflation Act. They've increased the standard deduction. So this is another thing. I know this is the girl boss community, single women. She ain't single no more.
I am single until married.
It's on the way. But anyway, but for those who are single women, don't have any dependents, this is good for you because the standard tax deduction has increased. Even for married couples, it's increased all over the board. So in 2022, singles had a standard deduction of $12,950. Now it's up to $13,850. And then if you're over 65, it goes even higher than that. The other thing that's changed, energy efficient home improvements. So back in the day, they really wasn't worth anything. You really didn't get a benefit from it. But now the government is moving toward more energy efficient things. And so now those improvements are getting you more deductions. Now it's a tax credit, but it's a non-refundable credit. Okay. And I don't know if everyone knows about that, but there are credits that are refundable, and then there are credits that are non-refundable.
What does that mean?
A non-refundable tax credit gives you a credit that will reduce your liability, which means the credit may have a larger amount, but it cannot exceed the taxes you owe. So if so let's say if you owe $5,000 to the IRS when you put your numbers in, but this credit gives you $7,000. You're only going to get $5,000. You don't get the overage as a refund. That's what a non-refundable tax credit is. It just takes care and it eats away at what you owe, but it does not equate into dollars back into your pocket. The other things that we know about are refundable tax credit. That's like the earned income. That's the child tax credit. That's the premium tax credit, where if you're getting Obamacare or getting health insurance from the marketplace, if your income says that you qualified for a reduced fee and you didn't get it through the marketplace, the government gives you the money back. That comes into your pocket.
I don't think I get any of that. I don't think I get anything where they give me money back. No. Let me be honest. Not one.
So most of these, and that's a good thing. Most of these credits are going to be for people who end up owing, and so they're increasing the amount because basically, people are like, if I ain't got no dependents, I can't win. If I ain't got a bunch of kids, and if I ain't getting earned income credit, if I'm making money, it's really nothing out there for me. And so these changes are putting things out there in place for middle to upper class people who make more money, who's making in excess of $100,000 a year. And so when you're making those home improvements, you definitely want to look at those because
did it get better than last year? Because I feel like I replaced my AC whole system in the wrong year.
You did. You really did. You really did. Because
I was putting those numbers in, y'all. I just knew I was gonna get a really good credit. Seeing that I had to buy a unit for 2 floors, because I got $300.
Previously, with the credit, with the home energy credits, they had a lifetime limit of $500, and so that
I got $300. See, I didn't know this.
So, but now here's the thing. Now the credit has been expanded, and it's for a long time. It's from 2023 all the way up until 2032, and it's going to increase to 30% of the cost of what it is you're doing to the home if it qualifies for energy improvements. 30% of the cost on installation, certain types of installation, boilers, air conditioning system, windows, doors, etc. If you're doing home improvements, or even
Michelle, you bought the windows in the wrong year. I hope you need some more.
Yeah, if you break a window, just something happens or accident, do something. Do something that's
we both need some back pay. We did all these home improvements in the wrong year.
Do something that's energy efficient, because the percentage has increased, and they also changed it from a lifetime limit to an annual limit, and the annual limit is $1,200. Okay, the annual limit is $1,200. With if you're doing something that's aggregate as far as exterior doors or exterior, if it's just exterior doors and it's classified as that has an annual limit of $500. And if you're just doing windows, it has an annual limit of $600. And you can do this every other year, every 3 years, from 2023 up until 2032. Exterior windows, lights, energy efficient lights on the outside of your home. All of those things now qualify for up to 30% with the annual limit of $1,200 rather. The annual limit increases to $2,000 if you're doing something with biomass stoves, hot water boilers, or electric or natural gas heating pumps in your home. Okay, and you also get another $150 credit if you do a home energy audit. Okay, have someone come and audit your home and show you how efficient it is. So that's that. So that has increased. The other change for 2023. Everything is about clean energy. So the EV now has a credit. Okay.
I know about these.
Yeah. So from 2023 up until 2032,
yes.
The
Biden
maximum
is trying
tax,
to take our gas stoves.
Yeah.
Yes.
The maximum tax break is at $7,500 for buying a new EV. If you buy a brand new EV, now there are stipulations to that. That don't mean you get to go out and buy a Tesla, because they're capping the vehicle cannot be more than $55,000 for sedans, and cannot be more than $80,000 for vans, SUVs, or pickup trucks. Okay, so it has to be within that range. So if you can't go buy a Tesla, I think you're going to get unless you buy one that's for $55,000. So it's trying to get more affordable.
Tesla has decreased the price of the Model 3 and the Model Y to be more competitive. So it'll go down.
Secondly, there are income limits to that. Your adjusted gross income, if you are married, joint filer, cannot exceed $300,000. If you are filing head of household, it cannot exceed $225,000. And if you are a single filer, you cannot make more than $150,000 if you want to try to get that maximum tax credit. Once again, it's a non-refundable credit. It's not money back in your pocket. It just eats away at your liability. And some people like, for that reason, if I'm probably going to do it, it may help if you're into EVs. It also allows you to buy used EV. Okay,
that's a biggie.
You get a smaller credit that's equal to the lesser of the fourth, equal to or less than one of the two, 4,000 or 30%, whichever one is the least. That's what you get. So if the 30% is going to give you more, you're capped out at $4,000. If the 30% is less than 4,000, then you're going to get what the 30% is. So if the 30% is 2,500, you get the 2,500. If the 30% of what you pay for the vehicle it equals to be $5,000, you're only going to get $4,000. Also, you have AGI requirements on that, 150 for joint filers, 150 for joint filers. So it dropped down from 300 to 150. And then for head of household, it's 112,500. And then for single filers, it's $75,000. So those have changed. The other change, and this is big too, just in case you do any business transactions online where you're selling goods or doing things on the side. We heard about it in 2021 that they were going to start tracking and sending us 1099K statements for those electronic payments like Cash App and things of that nature. The fuss was made so big that they kind of pushed it off. They pushed it back until now. So starting in 2023, if you're doing any kind of business through StubHub, Square, PayPal, you're going to get a 1099 1099K statement on that income if you're paid throughout the year, not just one time. If it adds up to something, anything over $600, you're going to get a 1099 statement. Okay. Now, understand this. It's point of clarification. It's for if you're selling and receiving goods. If you're just transferring money to family members or sending money to kids, that doesn't count. Okay. But if you're doing it a lot, they may question you. Zelle and
if she Zelle's her cleaning lady,
that don't count. They're not the Zelle is Zelle and Venmo to transfer to family and friends. It's not gonna raise a red flag. They may ask you to justify it, and you just say that. But more so than you getting in trouble or having a tax implication for sending money, it's really about the recipient. So you don't have anything to worry about. Your cleaning lady would have something to worry about because you're sending the money. So it's not going to come. You get it. A 1099K is a type of reporting for income.
Tell Miss Rubio.
Okay, but Venmo doesn't report. Venmo doesn't report.
Does Zelle report?
Zelle doesn't report.
Okay.
Zelle doesn't report. But Cash App, StubHub, PayPal, things of that nature, they will. Okay, but Zelle is kind of the ones everybody's kind of going to now because they don't report as of yet. Okay, if they start doing stuff with it, they might start. But like I said, if you're just transferring money or if you're just sending money to pay people, you have nothing to worry about. The receiver is the one that has something to worry about because they should be reporting that income as income. And so they'll be the person. And so I'm pretty sure if they start seeing people who receive a lot of money on these online transaction apps, you will get some kind of 1099K at the end of the year saying you received this money. And you're going to have to be able to justify, why you received it to avoid tax implications. Okay, so those rules come in. Also, the standard mileage rate has increased for those who own businesses. They increased it to 65.5 cents a mile if you travel. So that's a big thing. The mileage allowance for medical, all the mileage allowances has went up. For medical travel, it's went up to 22 cents. And for charitable driving, it's went up to 14 cents a mile. And that didn't change. That's been 14 cents forever because that's what it is by law. Okay. So those are the few changes I want to go over. Now let's talk about some tax tips. We have some
scenarios.
Yes.
I tried to think about the community and who was asking for the tax tips.
Yeah.
So we're going to start off with my group. All the single ladies, all the single ladies, all the single. Put your hands up.
So single persons who are high income earners, here's some tips for you. The first thing you want to do is check your withholdings. Check your withholdings. Make sure that you are allowing the appropriate amount to be withheld. Because if you're a person who at the end of every year, you keep on owing the IRS large sums of money, you need to talk with your Human Resource Department, talk with your employer and see what's going on because that something is happening where not enough money is being withheld. And this may not apply to you because I know some of y'all got these bonus incentive packages and that may hurt you as well. So if you're a person who gets a lot of bonuses, here's what you need to do. Track your income because if you get bonuses and they just tax you on the bonus, they're only taxing on that 25,000, or that 20,000 or whatever it may be, but they're only taxing it probably at the percentage of what it's in, which is 10 or 12. But because of all the money that you made in the year, you've already made it to level 5 in the tax bracket. You get what I'm saying? So that means you got to keep tabs on that. So when you get that bonus, check and see where that puts you for the year and see how much they've taken out of that bonus at what level, and more than likely they just did it on the 20 grand and they did it on that level. And so that means you need to know if I've already made it enough income in the year where I'm being taxed at 24% and they only tax this bonus at 10%, that means there's 14% of this money I need to take out. And I can either send it to the IRS in a form of a quarterly payment, or I can put it in an account and save it.
Can individuals pay taxes quarterly?
Yes, you can. You can pay quarterly taxes. Matter of fact, that's a good question, Ms. Kim, because The IRS now has changed the rules. If you are a person who is continuing to owe consecutively, the IRS now is making and requiring W-2 wage earners to make estimated tax payments. They hadn't done that before. Typically, the only persons who made estimated tax payments were 1099 wage earners, persons who were self-employed. But now, because the IRS is ramping up collections and they're trying to get some of this money that they put out back into the house and people that are owing them, they're saying that if you owe, like if you owe 16, 17, 18, 19, 20, every year you're owing and you're not paying it off. And even if you are paying it off, they're going to start require you to make estimated tax payments based on what your last year's tax return is. So if you're a person who keeps owing, and then in 2022, you owed $5,000 on top of what they took out, the IRS is going to take that $5,000 and divide it up over the 4 quarters of the year and say every quarter you need to send this payment in because you need to make quarterly payments. So that's why I say it's very beneficial that you watch your withholdings, check your withholdings if you're high income earners. And when you're getting those bonuses, either do 2 things: either make sure that you're sending it in or that you're saving it so that when you file your taxes, you can immediately pay it. If you're a person who owes and files extensions, you're going to run into that estimated tax payment because you're making the IRS wait on their money. And that's what they're trying to cut out. If you're not a person who files and pays at the same time and you owe consecutively, they're going to start making you make estimated tax payments in the near future. So definitely check on that. Second thing, for high income earners, I feel it's always best to itemize. If you're single, that 13, you're making all this money, that standard deduction, even though it's went up to 13,000, that ain't gonna help you. So you need to itemize, and that means you need to throughout the year have your tax issue in mind, have your income taxes in mind. Make wise financial decisions. Make the decisions of what you do and don't do based on the tax implications it's going to incur toward you.
Such as?
Here's an example. My biggest client base are persons who either retire or take out loans from their 401k for whatever reason. And they don't realize the tax implications that getting that money put your hand down. Who's that?
That's my cousin Jeremy. He's talking about put your hand down.
They don't realize the tax implications it puts on you at the end of the year. Yes, you're penalized. Yes, it's taxed before you receive it. But that still does not negate that at the end of the year, you have to include that in your total income. You'll be able to say what they took out for taxes. You'll be able to say what they penalized you, but you still have to include it in your income. And that very well may push you, and this is what it may push you into some money in a high tax bracket where you haven't paid, and that's why you owe. So you want to weigh the pros and cons. Yes, it's available. Yeah, you can go and get it. And we saw this, and this is happening now. And a lot of my clients are dealing with this because we know in the pandemic, the IRS said, go get you can go get it. We waving the penalties, go get it, go get it, go get it. But they didn't tell you when you file, you have to pay the taxes on this money.
It's always a shooting.
And the last thing you want to do, and I tell you all the time, the last thing you want to do is owe that. The worst person to owe in the world is the IRS, because they don't consider a debt paid until it's paid in full, which means even if you're making payments, they're penalizing you and they're charging you interest, even though you're making payments. And it's at a percentage, and so it can be crazy. So definitely keep an eye on that. So itemize. And here's the things you want to do with your money. Find as many pre-tax vehicles that your employer offers. Okay, as many vehicles, as many programs that they offer you that you're able to put pre-tax dollars in. Max it out. Feed your retirement plan.
Yes.
Okay, if you're a high earner, feed your retirement plan. They've increased that this year. 2023, they upped the amount that you
Big
can
time.
put into these retirement plans. So do that. Put that money in there because you will be taxed on it later. You will be taxed when you withdraw it. Okay, but it helps you right now lower your taxable income, your AGI, for where you are now. And you can deal with that at that appropriate time. So max that out. Another way, if you're don't want to do that, you like, I gotta pay tax anyway. Well, take advantage if your company has a flex plan. I know many people put money in the HSA plans, but see if your company has a flex plan because HSA has limits and they can still.
Oh Lord, Sister McLean.
Oh Lord. The HSA plans can still have tax. They still tax you on that. They still give you a statement on that. But with those flex plans, many times you can put pre-tax dollars in there. When I say pre-tax dollars, that means you're bringing down your taxable income. You're putting pre-tax dollars in a place, and they're not even going to take it when you use it. So you can use it for those medical bills or whatever the criteria the plan says. So you're basically putting money in a vehicle that's tax-free. So if your job has any kind of flex plan that you can put pre-tax dollars in and lets you purchase stuff, eyeglasses, or whatever it is, do that because that's literally tax-free money because you're not being taxed on it through your income and you're not being taxed when you pay for the items it allows you to pay for when you use it. So those are good things, okay? If you have mortgage insurance, you can write off those interest payments on your mortgage insurance, not homeowners insurance. Okay, but mortgage insurance. Some mortgages make you insure the mortgage. If you have that, if you're in that kind of plan, you can write off that interest payment up to a certain extent in that. So you definitely want to look at that. If you have a plan and you refinance some stuff and you got mortgage insurance, you can write that off. Medical bills, and dental expenses qualify as a tax deduction. But here's the stipulation. You can only deduct the cost that exceeds 7.5% of your AGI. So for example, if your adjusted gross income is $100,000, you can deduct out-of-pocket medical expenses that are over and above $7,500. Okay, so sometime it happens. You may want.
That's why last year, TurboTax just came out and asked me, "Did you spend more than $13,000?" Yeah. I was like, "No." Went to the next slide. Yeah. I was like, "Wait a minute!" I had my little. If
it's not over the 7.5% of your income, it really doesn't make a difference. Okay, but those are that. But that's all I have. The tips for the high income. Do we have any questions or anything?
Lots of comments.
Okay.
I will also say another tip that he didn't include that helps me the most is that I always give more than 10% of my salary to charity. Mm-hmm. That right there is my biggest win. Yeah. I'm always like teetering on little of nothing until then.
So to answer your question, what about medical expenses that are reimbursed by your FSA? Are those tax deductible too? No, they are not. You got the money back, so you're not able to write that off. It's not tax deductible. It has to be unreimbursed, out-of-pocket medical expenses. Mm-hmm. If you reimburse, they're not going to give you a tax break for that. So awesome. That's that. All right. Any other questions for high income earners before we move on?
For those of us who are single who normally don't get any breaks.
I mean, there are other tips. I just tried to pick out some that, so the list, it can be all
those
day.
Those are good. But also, like you said, the mortgage insurance, like me owning a home now definitely helps. Yeah. I paid a lot in property taxes. And
property taxes is something that you can deduct. Yes. It's best. So, and here's the thing, to be honest with you, these programs make it so easy. Especially for those of us in Texas. I know many people swear by TurboTax, but there's a free software service that's just as good called Free Tax USA. If you haven't ever used that, that just like TurboTax, they kind of offer the same features, but they have a program with the government where they let you file your federal taxes for free. We're in Texas. We don't have state taxes, so we don't have to worry about that. So you can even save money there with not having to pay the little fee that you pay TurboTax, because you're basically doing the same thing yourself. And I can tell you this, don't pay for that audit representation because it's not worth it. You need to keep detailed records. If you get audited, the only thing that's going to save you is proof. So you need to make sure that you understand what your deduction. One last question. Yes, they are. Yes, they are. Moving expenses are tax deductible as long as they're not reimbursed by your employer. So if the expenses are reimbursed by your employer, you can't get a tax write-off for it. But if you're relocating for your job and things of that nature, those expenses are tax deductible as long as they haven't been reimbursed.
Oh, we have a free Tax USA user.
Okay. Yes.
Never look back.
Yeah, it's the same thing. So you don't have to worry about any fees. It lets you file your thing and ask you the questions. It does the same thing basically that TurboTax does. And so
y'all, I'm today's years old when I found out about free Tax USA. I've never heard of that before.
So, but the biggest thing for high income earners, make wise financial decisions. We have a habit of just waiting to deal with taxes when tax time comes. You don't wait till your house is on fire to buy insurance.
Which is why I thought of doing it this month, because most of us just recently filed our taxes and we're either you in pain or you still crying. So I will say that's why we're doing it now. So you have a few more months this year to get your tax house in order. And I think Michelle is asking the question that will transition us.
Okay.
Going from single to married, that first tax year, no one teaches that. Oh my gosh. But we're going to talk about business owners.
Okay. Okay. We're going to come with business owners and then we'll close out with married and changing and going from single to married and all that kind of stuff that goes on with that.
Yeah, so, I got my space ready because we're getting married. I'm going to need all these tips.
All right. Business tax deduction. So first of all, if you have a small business, you want to make sure that you're able to get every write-off and every deduction that you can, because the more of that money that you write off in the business, the less you have to pay taxes on. But the biggest thing I tell all small business owners, the devil is in the details. And if you keep good records, you will always win. Okay. When it concerns the IRS, documentation beats conversation every day of the week. The IRS don't want to hear your complaints, your excuses. They're not going to read your letter explaining your extenuating circumstances. You need to have documentation. So if you are a business owner, your best weapon in dealing with your tax liability and offsetting that and making sure that you get the biggest deductions when you file is making sure you keep good records. Keep good records. And then secondly, another problem I run into in my business is do not convolute the money. Okay. Let the business money be the business money and the business account be the business account, and have a separate personal account. Because if you just have an account that do both and the IRS looks at that account, because they can and they will, and they see all these personal transactions in your business account, they're going to say, this ain't no business account. This is a personal account, and we taxing you on every dime that's in here. Because you convoluted. How can we tell what's the business and what's yours? Wow. You're doing both. So the biggest thing is keeping detailed records and separate. Okay, pay yourself. Pay yourself. You can pay your bills through the business account, but all that grocery shopping, eating, the personal item, don't do that. That's a quick way for the IRS to disallow and disprove business expenses because you're convoluting buying your kids clothes. No, let it be business bills. You can set it up where you're the CEO, you're the president of the company, and a part of your package is a rental or a housing allowance. All of those things are great. The company has agreed part of your income package is to pay your housing bills. Those things are fine. But I'm talking about going out to eat, buying purses, buying clothes in a business account. That's not good. Don't convolute the money.
Don't treat yourself at the business account.
Exactly. Okay.
Is what he's saying.
Also, another thing, the biggest thing with business owners, if you're doing anything with contract labor, okay, and let me back up a little bit. Be familiar with those general business expenses on that Schedule C, okay, and put the appropriate numbers and just keep the good records. But the next thing, when you're dealing with contract laborers, the same thing goes with that 1099 that we talked about with those electronic payments. Once you pay a person over $600, they need, or if you anticipate you're going to pay them over $600, you need to have them fill out a wage form, a 1099 form, so that you can have the information so that you can report to the IRS what you paid to contract laborers.
Is this Nichelle and Miss Rubio, her cleaning lady?
Not necessarily.
Okay.
Because Nichelle doesn't have a business.
Oh, okay.
This is for business owners. Nichelle doesn't have a business. She just paying. Miss Rubio needs to be tracking her own money. That's
her business.
That's her business.
Okay.
She needs to be tracking up what Nichelle pays her. But Nichelle can't deduct what she pays Miss Rubio because she's not claiming a business. She's so this doesn't apply to that.
Okay.
This is for persons who have business, 1099 wage earners who are carrying a Schedule C with those business deductions. Okay, if you have a business that you're doing, whether it's a sole proprietorship, LLC, C Corp, S Corp, you need to track those payments that you pay to contract labor that's going to go over $600. And you need to send a 1099 to the IRS at the end of the year, because the IRS will disallow your contract labor deductions and equate that as income toward you, make you pay taxes on it if you do not report the 1099s to them that I paid so-and-so these dollars. Mm-hmm. Even if it's in cash, keep receipts, have checks. Trying to do anything in cash if you're paying contract laborers. Have a tracking system and send that to them, because a lot of my clients, they get in trouble because they were like, yeah, I got a contract. And that's the thing. We have these general contractors who go and hire subcontractors. The subcontractor has a business, but the general contractor paid him $100,000 to do a job. The subcontractor had to pay all of his people probably, let's say, $75,000 of that money to get the job done. But that general contractor is going to report to the IRS that I paid that subcontractor $100,000. And the IRS, if you don't do those 1099, send those 1099s in, they're going to expect you to pay the taxes on that $100,000. Okay, you may be able to write off materials and things of nature, but you won't be able to write off contract labor. Okay, business deductions, any legal or professional services. If you pay to get your website done, if you pay to get flyers, if you pay for a lawyer, if you get somebody sues you, if you pay to get your taxes done, all of those are legal fees that you can write off. 100% deductible can write off. Let's talk about home office. And I want to talk about this because a lot of you all are working from home. There's a difference between working from home and a remote worker. If you're a W-2 wage earner, you don't work from home, you are a remote worker. Yes, tax prep fees are deductible for anybody. You can, even as a W-2 wage earner, if you pay fees to get your taxes done, you can deduct those. Those are tax prep and legal fees. You can deduct those fees. They're 100% deductible, whatever you pay to get your taxes done. Okay. So back to the home office. Home office is for people who work for themselves. If you work for a company, but they allow you to work remotely, you don't get to claim home office expense. It's just not happening. It's not. There's no way around it. You can't do it. Okay, you have to.
I know because I looked.
You have to be working for yourself, to claim that. Okay, and because you work for yourself, that's your category of even a portion of your mortgage, your rent, your property taxes, the cost of utilities, repairs, maintenance, and similar expenses can be written off through home office expense. Now, here's the stickler. The space you're using must be used exclusively for the business. It can't be your office in the daytime and your she shed at night. It has to be strictly for the business. Okay, so and you can do that. Now, there are two ways you can do home office expense if you are a 1099 wage earner. It's the simplified version, which is very easy. And the simplified
Yes,
version,
girl, she said.
yes, the simplified version, if you're not good at keeping records, if you don't know the square footage, all that kind of stuff, if you ain't really got a big space, or if you really ain't, if you just ain't up on the up and up, the simplified version is for you because it doesn't really require documentation. And the IRS rarely audits on the simplified version. Okay. Because the simplified version, all it does, it allows you to deduct $5 per square feet of your home up to 300 square feet. Okay. You don't have to keep records about that. You just get $5 for every square feet up to $300, and that will be your home office deduction. Okay. Now, if you want to do the actual expense deduction, you then have to calculate the square footage doesn't change. The maximum is still 300 square feet, but you multiply or calculate the percent of what that is in your home. Okay, so the bigger the home, the smaller the percent. Does that make sense?
Yes.
The smaller the home, the bigger the percent. Okay, and you take that percent, and that percent allows you to get that percent, whatever percentage of your whole square footage is. If it's 20%, 10%, 30% of your home, you're able to then deduct, and this is why it gets audited a lot, you're able to then deduct that portion of your mortgage, a lot of money, that portion of your rent. See, that's where the money comes in when you do the actual expense, because if you have a smaller home and that 300 square feet equates up to 15 or 20% of your home, that's the amount that you can write off from your mortgage. 15% of your mortgage can be written off for home office. 15% of your rent is tax deductible.
So now, like my former braid lady who had the little room and I would go get my hair braided. She went out, she closed shop. She went out of business.
Now repairs are under a different rule. The repairs, you only get the maximum percentage if it's in the actual area of the home. You can't change windows everywhere in the home and say, you may get a small piece, but it won't be much. It's really targeted toward, if you do repairs or things of that nature, it has to be repairs to that area. Okay, but you will get a percent, but you won't get much. Okay, but if you're trying to do repairs, if you're trying to claim repairs through home office expense, it has to be repairs that are in that area that's exclusively used for your business. That's how a lot of people get audited and they get in trouble and have to pay the money back because they repaired the home. They're like, well, I'm painting my whole house. No, you painted your whole house, so you don't get to put all that weight in that office. You see what I'm saying? So that's that. Also, another big deduction, this is one of the biggest if you are a business owner, is the Section 179 expense deduction. What this does, it's an accelerated deduction. This is really for people who are really doing business and buying machinery or buying equipment. This accelerated depreciation. It allows you to deduct the entire value of a product in one tax year. You get write off the entire amount instead of waiting over time to do it through depreciation. Okay, and that can be up to it's capped at $1 million. Okay, you can write off up to $1 million through Section 179 if you have that. Okay, to claim the deduction in the tax year, the equipment must be financed or purchased and placed in service during that same year. Okay, and this applies to tangible property except land, such as buildings, machinery, vehicles, equipment. It also applies to non-tangible property like patents. If you're doing sales, if you're buying copyrights or customer list or lead, or if you're buying leads, you can write all that off. You pay somebody, I want to get my business on, I pay somebody $50,000 to give me 1 million leads. I can write off that entire expense through Section 179 expense deduction and get the entire amount in that tax year. Even if I didn't pay it all in full, even if I just paid a portion, even if I financed it, I can write off the entire amount that was financed in that tax year if I put what was purchased in action, in service during that year.
We have a question.
Okay, we got a question. All right, what's the question?
What about miles on a vehicle? Are those deductible? And if you use your personal vehicle for business?
Okay, so if you're using your personal vehicle for business, you can get it. You just won't get the maximum amount. If the vehicle is exclusively, if it's more for business than it is for personal, you'll get more. But when you go to the tax, they're going to ask you how much time is this used for business, how much time is used for personal.
That seems like a lot of tracking.
Yeah, I want to say it's all documentation beats conversation.
We need to put that on the T-shirt, y'all. Documentation beats conversation.
And I tell people all the time, and I'll say this: in my experience, it's my opinion, and some people may disagree, but in my experience in dealing with persons who deal with audits, whether it's a W-2 wage earner or whether it's business owners or sole proprietors, the IRS regularly audits that section of tax returns because they know people don't keep good records. When you start dealing with depreciation of the vehicle, you got to know what you're doing to keep up with that stuff. You got to know from year to year. And if that stuff gets wrong, they come in at least for the last 3 years. Wow. So I tell people, unless you're really tracking it and really keeping good records, it ain't worth it. To me, it's not what you get. If it's a car that's used for business and personal, sometime it's not worth it. You have to make that decision. But in my experience, that's one of the easiest ways to get a red flag thrown on you, to have your return pulled and have it brought in for examination when you're doing stuff on that mileage, because because you say you're doing that mileage, they're gonna want to see it. They want to see you prove it. They want to pull it. Okay, so I'll be very careful with that. You can do it if you're doing it. Hey, if it's something you qualify for, by all means do it. Okay, but if you're a person like me who don't want to have the headache of having to go through audit because it is a headache, then I would try to look for something else. There are other things I feel that will give you a better tax break than trying to play with that vehicle.
Has anyone ever been audited? In the chat, leave your comments about your audit experience in the chat. We'll get to it.
All right. So one of the last things for businesses, and we're moving on, is bad debt. You can write, if you're a business owner, you can write off bad debt. If you loan some money to a employee and they never paid you back, you can write that off. If you extended credit to somebody and for your goods and services and they never paid, just like these big companies, you can write that off. You can write that. You can write off bad debt. If you got bad debt and there's no way to recoup it, you can write it off. You just have to be able to prove, once again, documentation. You have to be able to prove that it was a business debt and not a personal debt. You can't say I gave my cousin $500 and they pay me, I'm gonna write off. No, that's personal. It has to be connected to the business. So loans to clients, loans to suppliers, distributors, employees, credit sales to customers, business loan guarantees. You can write off bad debt, and that can be a tax deduction. Okay.
Now.
Well, let's ask them a question. We got some business owners that got some questions. You ready to rest?
Okay. Yes, I'm because we're gonna be newlyweds soon, so I am biased on that topic. Sorry, you guys.
I figured as much.
Okay, but any business owners in the chat, do you have any questions?
Or future business owners.
Yeah, if you're thinking about
startup costs, you can write off. You're starting up a business. All your startup costs, you can write that off to start your business.
This is really great information, you guys. Like, hit the like button if you are enjoying and think this is really great information. So
can
go
we
ahead.
See the hearts? Can we see the hearts? One heart. Oh, that's what it is. Oh, yes. Okay. We need more likes. I need more likes.
We need more likes, you guys. Please. Go ahead and hit the thumbs up if you are really getting good information, if this is really helping you.
Okay. I haven't been audited, but I know someone who has. He's been falsely claiming deductions for large cash donations. It took the IRS. But once they catch up with you, this is gonna be hell to pay. And you can't prove it. So be careful with that and keep those records. When you file your return, know this, the IRS can only go back the past 3 years. Okay. That's good
to know.
The IRS can only audit you for the past 3 years. So when you turn those returns in, you can, keep those records for at least 3 years. And let me say this: there's always an exception to the rule. If they feel that there was some criminal activity, fraudulent, they can exceed that 3-year rule. But typically, the IRS doesn't pull a return for examination. That's all the audit is a close examination, not taking your word for what you put on the return. Doesn't happen outside of 3 years. They basically only go back 3 years. Okay. So keep your records when you file for at least 3 years and then get rid of them. Okay.
Okay. Now, anyone that have questions about if you're going to be a newlywed, if you just recently got married and you don't want any tax issues, leave it in the chat. So we will get to the questions as he's going along. But we're now going to switch up tax tips for married people. I've never been in this category. I don't know nothing about it.
So the biggest thing that I tell people all the time is you get the biggest, married people get the biggest tax break when you file jointly. The biggest tax break comes with filing jointly.
We need to get married this year.
However, many times married couples don't take them for a plethora of reasons. And I'll let you figure out what that is, but because they're not, they kind of do things separately in their finances and things of that nature. So they stop them they don't file jointly. And when you're married and you need to have a conversation with your spouse, okay, ask them about, do they owe taxes, what they got going on, what's in the situation, so that you can know, because filing jointly with a spouse who owes for a previous year, owes a past tax liability, is not going to make you liable, okay, for that old tax debt. However, if you guys get a refund jointly, the IRS is going to offset that refund by what's owed unless you sent and file an innocent spouse form, okay? It won't make you liable, but your refunds can be offset for your spouse's back tax issues. It won't make you liable, but they will take the money since his name or her name is on the return, okay? Because they're not going to spend time. The IRS don't divide and do community property. They just, if you got some money and it's attached to your social, we coming to get it. So talk to them about it.
We got a question.
No. Married filing jointly gets the biggest benefit. Married filing jointly gets the biggest benefit. Married filing separately gets a lower standard deduction, okay? And there are different situations, because if you have filed this way due to his old tax, and it's really, it could be her, married filing separately, yes, married filing separately, and the reason why it's called is some tax preparers call it a marriage penalty, because when you file separately, there are a lot of credits that you cannot get because you file separately. You can't write off student loan debt. There are a lot of things that once you file separately, you just automatically can't get earned income credit. You can't get none of that stuff. When you file separately, you really cut yourself in all of these benefits, the code that they put out here to help us. You get none of that. Come on.
So could you file jointly or separately 1 year, then jointly? Like, can you switch, or do you have to stay filing the same way once you get married?
You can switch depending. Your filing status is your filing. You can switch from year to year. However, you get the biggest benefit when they start doing stuff in the tax law if you are consistently filing jointly, because there are certain tax breaks that you get that are continuous. That you get some this year, and you can get the overage the next year. So the system is set up to where you get the biggest bang, you get the biggest deduction by filing together. Okay. Now this works, especially sometimes it can work or hurt. So if one spouse makes more than the other spouse, it can kind of help, because I talked about those, how they increase the tax brackets to widen them. So it's wider on the married side. So when you file jointly, they've already increased it as single, but so much more of your money gets taxed at a lower rate because it's wider at the married filing jointly level. Okay. And when you file separately, it locks you in, which means when you're married, if your husband files married filing separately and he just chooses standard deduction, the other spouse has to do the same thing.
Oh.
The other spouse cannot itemize. And that's what hurts, because you may want to itemize because you got all these expenses, the house in your name, you got all these bills, you got this, you can't itemize. If one spouse takes the standard deduction, the other spouse has to take a standard deduction. If one spouse itemizes, the other spouse has to itemize. Okay,
you gotta be matchy.
You gotta be matchy.
Yes.
You know what you mean? And a lot of people don't know that, and a lot of people sometimes try to go around that. I have a lot of clients who get away with it for a long time. They legally married, but they've been filing single. But when the IRS catches up with you, they're gonna get you, and you're gonna pay.
Dear.
So it's always best to file. Now there are some situations where it's not best to file jointly, especially if both of you are going to itemize. Then it kind of helps you. Okay.
That's my cousin-in-law, Rainey. We will just continue to file jointly.
Yes. Okay. So yeah, the married filing jointly status is always going to give you the biggest benefit, and it definitely helps because once y'all come together, it taxes at a lower tax bracket, especially if one spouse makes a more than the other spouse. It's really going to help if you file jointly. Okay, it'll help widen that gap. Now, if you're two spouses and both of you are high earners, you got to kind of look at that and maybe talk to a tax preparer, because that may be a scenario where y'all may want to file separately because y'all just together make way too much money. If y'all over 300,000 together, 400,000, you may want to go talk to somebody and kind of look at what it looks like both ways to see what it would do. But if one spouse is making 90 and the other spouse is at 50, y'all need to go and put that together. Go and file jointly. You're gonna get the biggest tax break. You get the biggest tax. Y'all gonna get some money back. Y'all gonna be good because you get a lower tax rate. Also, when you marry file jointly, say if your spouse gets laid off, you now get to you can take your money. You can put more money in a spouse IRA and get the maximum tax deduction on that. Okay, you have a spouse who got laid off or who's a stay-at-home mom or whatever the case may be. Still file jointly because now you can take your income and start putting it in tax-deferred vehicles in your spouse's name and get the tax benefit for it as well. Okay, so definitely do that. And so that's really all I have about the tax, the married filing joint. You get the biggest benefit. But definitely have a conversation about the tax implications. Find out how your spouse has filed, if they filed. Okay, because you have some people who ain't never filed taxes, who they out of compliance. And if they haven't been filing in 7 years and they just pop up with a return, the IRS will like, wait a minute. Because the income been reported. Where you been for the last 10 years, brother? And they will hold up your return until they get their other business straight. So I think the biggest thing for newlyweds or married couples is having that conversation and being on that same page as you should be in the marriage anyway, and talking about it and just deciding what works best for you. With taxes, every situation is different. And sometimes you may have to look at it from year to year, but just take your time and look at it and do what's best for your situation. But know that when you do file separately, there are some negative feedback to that. And for the most part, many of the times, filing jointly is always going to give you the best benefit. Okay.
Any questions from the married couples? Okay, we have one.
Okay.
What happens if one spouse owes child support arrears? Is there a tax implication if the couple files married/jointly? That is, can refunds be garnished even if only one spouse is on the hook?
Unfortunately, if your spouse owes arrears and the Attorney General has put in a lien on your spouse, they will offset the refund.
Oh.
Okay. So, and there's a way to check it. You can call the IRS and your spouse can enter the information and they can tell them if anyone has put a lien on them, and they'll tell you what agency. So there's a way to find that out, because just because you pay child support, just because you may be a little bit behind, doesn't mean that the that the Attorney General has put a lien against you. You have to get to a certain point before they do that. Okay, so check that out and see. But if they have put a lien on them, if you file jointly, then your refund will be offset. They will offset it, and it's going to go to that baby mama. She gonna get all your money.
Any other questions for married couples, those who are thinking of getting married? Todrick and I have a lot to talk about and figure out, but I know y'all can tell which one will be filing our taxes when that day comes. It won't be me, and we won't be using TurboTax anymore. I'm sure he will not let me keep using TurboTax. Any other questions? Any questions on any topic? Now, before we close, I will say he did tell me that if you owe money, you have to file by the tax deadline. But if you don't,
so the tax
different.
So the tax deadline, you want to try to file by the tax deadline. But if you are very, very sure that you are not going to owe, there are no penalties in place for you. So there are no penalties for you. You don't have to worry about the deadline is for people that owe taxes. Because if they don't file by a certain date, even if they file an extension, the IRS is going to penalize you for a failure to pay, and they're going to charge you interest for all that time you didn't get them their money by the 15th. So the filing deadline is literally really for people who owe. If you do not owe the IRS, the tax law says you have up to 3 years to claim a refund. You can wait, but after 3 years, you run the risk of not getting it. After 3 years, the IRS does not have to pay you any type of refund for that return. So
yeah, I also learned that this year before I filed my taxes, because I was a little stressed. Y'all, I waited until probably the weekend before to get it done.
And then also, don't rush. Make sure and keep it with those people. When you get stuff from your mortgage company, if you got 401k, when you get those tax statements, make sure you keep up with those. A lot of people get in trouble for underreporting. They forget that they got this money. They forget that they got that. And then they file them taxes and they get a refund. Then the IRS say, hey, wait a minute, you forgot to include this. And we added it in. And when we added it in, you owe us money. And I have that happen a lot. I have a lot of clients who are like, why do I owe? I never owe. Well, you forgot that you started getting Social Security and you didn't file it. Or you get Social Security and you work. Many times Social Security isn't taxed for persons who are receiving it. But if you got Social Security, pension, and other stuff, and it puts you over a certain amount, you did run into having a filing requirement and you got to pay taxes on it. And so I have a lot of elderly clients who are really in bad straits because they're like, why do I owe? I waited till all these years, I've been paying my taxes, but now, oh, well, you get Social Security and you got a part-time job and you get a pension. Listen, if you owe and you didn't make the 18 date, what's the perfect? I would say just make sure that when you do file, you don't wait a long time. And when you do file, you be ready to pay what you owe. The IRS will allow you a one-time penalty abatement. So get the return filed, pay what you owe, and then call the IRS and ask them for a penalty abatement. They will never waive the interest. They will waive the penalty. And they will do it one time for a tax year. So just try to get the money together that you owe and file it, send it in with the return. And then once it's in, processed, call them and say, hey, because you're going to probably have a balance. Say, hey, I want to do, I'm asking for a one-time penalty abatement. They'll give it to you, and that probably should have you squared away.
I'm learning so much, you guys.
If it's something where you say, well, you know what, I just can't pay it all at one time, the IRS assesses penalties for the time that you don't pay, but they only do it like around the end of the year or at the beginning of tax season. So at a certain time, they only assess it at one time. They calculate it for all the time, but they only assess it one time. So I tell people the quickest way, if you can't pay it all at once, try to pay it within 6 months to a year, because that's going to mitigate the penalties and interest that you have to pay. And you'll probably just pay maybe $100 or $200 more than what you owe, give or take, depending on how much you owe. Okay, so make a payment arrangement and try to pay it off within 6 months to a year. Okay.
Thank you. Thank you.
Thank you.
Yes, we're very excited to start our journey together. And that does include, tax implications. And I did, after filing taxes, y'all, so many of my friends had questions for Todrick that I thought it was just best to host a Budget and Bills and bring him to the community so you all get to officially meet the love of my life, my forever love. And he is so smart, as you all can tell, and so educated in his profession. So we're going to sign off, but don't forget to hit the thumbs up video. And if you know anyone who needs this information, I'm doing this to help you guys. Please share this with your network. Post it on your own social media. Make sure you're commenting, you like, so that, more people can join the Girl Boss Beauty community and we can get our budget and bills together. All right, guys. Have a great day.
Bye.
Bye.